A lot of founders we work with are growing their top line revenue, but they're always battling to fund inventory growth. And then when I look at their profits, it feels like they're working for whoever's providing the loans. And that is just heartbreaking, and it's something we see so regularly with so many sellers. Welcome everyone. Today we've got a super interesting discussion around one of the most damaging things that I find sellers are getting involved with, which is the wrong kind of financing for their business. We've got Linus from Tech Credit Partners joining us today. And yeah, Linus, welcome. I'm so excited to chat to you. I think it's going to be such a useful discussion for our listeners.
Well, thank you so much for having me here, Richard. I'm really glad to join, and yeah, I look forward to getting into the nitty-gritty details of all the different financing options that exist out there in the market, and sort of the common pitfalls that we typically see e-commerce companies stepping into when thinking about the sort of financial product stack that they use for various types of use cases.
Yeah, I'm looking forward to digging into it. Also, Linus, you've got one of the more honest ways of talking about this, because you're not a direct provider of the finance. You're working on behalf of the actual e-com founder. So just before we get into the details, I think it's important for us to cover how you landed up where you are now and what led to you starting Tech Credit Partners.
Yeah. So I started my career as a consultant and an advisor, primarily actually working for really big retailer and e-commerce companies. I did advisory projects for companies like Sainsbury's, ASOS, which I'm sure everyone would have heard about across the world, Royal Mail, etc. And often on these engagement, we touched upon optimizing financing or raising financing or doing M&A, etc. And then I wanted to do something a bit more hands-on and entrepreneurial. So in 2019, I joined this early stage, fast-growing technology company. It was a super exciting journey. We took the company from basically zero revenue to a couple of million. And at one point, when we wanted to raise some capital for this business, we started to think about what different forms of debt financing is there actually available for us. When we were going to raise the capital, this was sort of in mid 2022, and I'm not sure if you remember, but equity markets was really tough at that point of time. So we started to look for different kinds of financing options that could help us to minimize the dilution, save ourselves as much equity as possible, or extend our runway so that we could hit a new milestone before we sort of went out and raised the equity. And that's when my eyes opened up for the different debt options available for what I would call the sort of lower mid-market or the early sort of fast-growing ecosystem of companies. And this was quite, I was going to say, exciting, but also quite shocking to me, because when we started to really dig into this space, we realized that there was, first of all, so many different funds, banks, alternative financing companies. Alternative financing companies is what I would mean with these kind of revenue-based financing companies, for example, working capital specialists, etc. And it was just really difficult to understand what was actually, first of all, the products and the structures that these different financial institutions were offering. Secondly, it was really difficult to understand what was actually the products and the structures that they offered, and what was the sort of optimal use case for those products. And secondly, understanding, what I'm sure every founder or CFO are really keen to understand. What is actually the true cost of this capital? Like, how does this cost actually compare with the other offers in the market? How does this cost compare with the cost of equity that we're potentially raising? And I realized that this market was extremely complex. There was a lot of new products being added. It seems like it always was happening on a kind of monthly or a quarterly basis, with different types of revenue-based financing structures, venture debts, ARR loans, etc. And we just couldn't find a lot of good, literature or resources, or even advisors or brokers that was very focused on guiding companies through this very complex landscape. So at the end of the day, we had to do the work ourselves, and it took an awful lot of time, an awful lot of headache. We spoke to tens and tens of banks and funds and revenue-based finance players. And at the end of the day, we were never really sure that we actually had the best offer on the table. And, we had to kind of accept that harsh truth. We closed some debt funding, and then we sort of moved on. And then what I actually started to do later was to then help my friends or ex-colleagues or acquaintances that was also thinking about debt raising, and they experienced the same kind of problems that we had come across, and therefore we helped them with the knowledge that we had acquired from going through the process. And we saw how much time and money we saved our friends. And I had this hypothesis that equity was going to continue to be very, very expensive for most companies, unless you're an AI company funded by Sequoia or whatnot, and it will continue to be very, very expensive, and that the lower mid-market that landscape was going to continue to complexify with more offerings coming in, more products, more GPs, more alternative lenders, making it even more complex for CFOs and founders to actually find the right offer for them. And I thought this was a problem that was really, really worth solving. So I quit my job and started Tech Credit Partners. So Tech Credit Partners, we're essentially a debt advisory and a brokerage firm that works with typically fast-growing early-stage businesses. Some are management-owned and run, some are venture or private equity-backed, and we basically help them to navigate this very complex landscape and ensuring that they find the optimal source of funding for their situation and the use of proceeds that they have in mind.
It's super interesting that you guys are a bit of a one of one. Most of the brokers that with my other business, the accounting firm, we get flooded with people wanting to work with us to get to our clients, and almost all of them are just peddling the same type of short-term revenue-based debt. And I think and they're making money as a commission from giving the loans, right? Where you guys are actually acting on behalf of the founder to minimize their cost of capital and therefore maximize their firm value. And I really I think you're quite unique in the market there. It astounds me that there's not more of you because how messy this market is. But I think you're in a super unique space, and I do expect competitors to pop up in the future when they see what you're doing, right? But part of the challenge is also the relationships with actual funders. And I just think you've built out. I'm always amazed at how many people you're able to pull up in a week and actually have discussions with around real funding, not these revenue-based loans. So, Linus, I'm looking forward to working with you more on other clients. Let's get stuck into some of the details. Linus, we both worked with e-com sellers and founders for a while. From my side, the financial analysis, I am seeing a growing problem in that a lot of our founders we work with are growing their top line revenue, but they're always battling to fund that inventory growth, right? And then when I look at their profits, I look at the actual profit and how much they're giving away to the financiers. It feels like they're working for whoever's providing the loans. It seems very opaque, very confusing as to why. Can you talk a little bit about what you've seen with the majority of sellers and how they actually fund these inventory type loans?
Yeah. I completely agree with you, Richard. This is something that we often see when we start working with e-commerce companies, right? Many of them, I was going to say, have some sort of revenue-based financing in place. I think these financing players, they've raised a lot of venture capital, and they're really good at marketing themselves. They're really good at packaging the product and the offering, and to some extent, selling sort of a dream here. But it's very, very important to understand what these products actually cost and how much of the profits they can actually eat from your company. And quite often these products are packaged or marketed or structured in a way that it actually makes it really, really difficult to understand what the true cost of capital is. It's very often that we talk with founders or CFOs who will say, actually, we're very happy with our revenue-based financing provider because we're only paying 7% interest or 8% interest or 10% interest or whatever it might be. Now, that is not typically the case, because how these products are structured, it means that the effective interest rates that you'll be paying on one of these advances is typically the double or sometimes even the triple. And if you're paying 20, 25, sometimes 30% interest on a loan, that is obviously eating up a lot of your profit. With that said, these products can have some situations when they can be good. Banks or credit funds are not perfect. They often take quite a lot of time to acquire, and that is primarily because their return thresholds are so low, right? So they need to do a certain amount of due diligence and analysis on the company to make sure that it's a safe investment for them. So if there is a situation where a company is growing incredibly fast and they have solid financials and they know how they potentially can get themselves out from one of these revenue-based financing structures, yes, then I would say, then yes, you can make an exemption and get them on board. But if not, it's very easy to start using them and then sort of fall into what I would call sort of the payday loan trap, where because the structures are with such a short tenor, i.e. payback period, and also normally amortizing right from day one or from week one, or if in this case sort of from month one, it has a very, very significant impact on your cash flow. Think about it in the sense that, okay, I'll take out a loan for 100K. I want to buy some inventory with this money, but the inventory typically comes from, and if I'm a US company, the inventory typically comes from the Far East, right? So it's going to take me a couple of weeks or maybe months or maybe even half a year before that inventory is actually in my hands and I can sell it on. But in the meantime, I'm obviously repaying and amortizing on that loan that I took out from the revenue-based financing player. So the cash flow becomes quite penalizing in such a situation. And that's very often what we see, revenue-based financing players doing, and then ending up in a situation where they need to take out another loan to sort of cover for it, etc., etc. And yeah, it's something to flag, and something that we obviously recommend our clients to always analyze and truly understand how whatever financing product that they're taking on board, what impact it has on their existing and future cash flows.
So I think majority of founders are not super versed in finance and how the maths works here, right? So if we take, we're not going to name and shame loan companies here, but let's take something like Shopify Capital, right? There's a time and place where you might well need that, but it's a revenue-backed loan, right? So it's not the same as going to get a business loan where you have 3 years and you're going to pay back monthly installments and the effective interest rate is, say, 12%, right? So, Shopify loan will go, cool, we're going to give you a $10,000 loan, or if you're bigger, a $100,000 loan. It doesn't talk about interest rates. It says you're going to pay back 105 or 109,000 or 110,000, and you're going to pay back a percentage of revenue, right? And then always there's like a maximum term. The maximum term will be 6 months, but you'll end up paying back that loan in like 12 weeks usually, right? If you're growing. So you might go and say, oh, well, Shopify gave me 100,000. They said I only have to pay back 105,000. You're thinking, I've only got 5% interest. Well, that's 5% over a 3-month period, right? So the effective interest rate on that is really more like 20 to 24% compared to your annualized, proper 3-year note. And am I thinking about that correctly, or do you want to correct me?
No, that's exactly how it works, right? So that's one very typical way of how these products are structured to make them optically seen like they're quite attractive. We don't talk about APR, which stands for annual percentage rate. They talk about these loans in absolute terms, right? And if I'm a founder or a CFO, I get it in the sense that, well, paying 5K to get 100K is not a huge amount of fees, but when it is on a shorter period, the effective interest just becomes very, very high. Yes.
And it also kills the cash flow, right? So, like you said, if you're buying from China and the product's going to take more than 3 months to get to you, so you've borrowed that 100K to pay a deposit on inventory that you haven't yet received and you haven't started selling. So now you're paying for that loan out of your previous inventory sales, and it arrives. Now you've got to pay the other 70%, but you haven't increased just your profits at all. So like it turns into a bit of a debt trap cycle at a crazy interest. And what you and I have spoken about before is that you're actually just giving away who's getting the profit, right? So you end up giving these revenue-based loan financiers a much bigger chunk of your profits than you think.
Indeed.
And if I'm like, from the time we've worked together, what you're doing is you're coming in and providing clarity and doing the complex, getting through the opaqueness of those calculations and comparing what is the real APR. And then you're looking for alternatives that bring that from a 20 or 30% APR down to a more sustainable APR with longer loan terms, right? How do, in terms of those short-term loans, what do you suggest in terms of understanding how to do those calculations? Is there a way that that sellers should be thinking about the actual cost of capital? Or, are they just going, well, I'm paying $5,000 to get $100,000. They don't think about the periods. Is there some kind of simpler advice to how to roughly estimate that?
Yeah, I would say as a kind of a rule of thumb, if you want to do some calculations or estimations, very, very quick and dirty, if you're getting a discount fee or an advance rate on a revenue-based financing facility, I would say you can take the discount fee and multiply it with 2 or 3x. That's often how you get to the true interest rate. Now, if you want to be a bit more specific, I guess you can ask ChatGPT about your offer.
Yeah.
They be able to tell you what the true interest rate is pretty often. If you want to, do some more advanced analysis, then you should speak to your CFO, or you should ask the financing providers about a template to help you to calculate what the true cost is.
So you mentioned two types of fees there, right? So they are hiding these fees. Let's be clear. I think the purpose of their marketing is somewhat opaque to get you to sign up quickly, because their security is that they're just taking a percentage of your revenue, right? You spoke about a discounting fee. So there's kind of a couple of ways that they call these fees, which in effect are your cost of capital, the same as interest. What are some of the more common ways in which these fees are worded and therefore hidden compared to just saying here's a 14% APR?
Structure we see quite often is that they apply sort of a discount rate where you, for example, would pay all of the interest of the facility up front, so it's deducted from your principal. I'll want to take out a loan for 100K, let's say, and then a lender will say we'll apply a 10% discount fee on that, i.e. you will pay your interest up front, so that means they will only give me 90, but I will pay back 100. Now then I will amortize on this loan over a 12 months period, just to make it simple, which means obviously that the principal balance outstanding on my loan is decreasing, right? But I've still paid a 10% discount fee on this capital. Now I paid it up front, and I've also paid it as if it were let's call it a bullet facility, or the cost of this capital would have actually been 10% if it would have been a bullet facility. But as I'm amortizing, I'm still paying, let's call it 1% on 100K in month 11, when my outstanding balance, it's going to be 100K. So then my interest rate is, hundreds and hundreds of percentages in the last months. And then if you kind of average out the monthly, let's call it APR, then you typically end up with something around sort of 20 or 30%. Now, what I will say again is, these products can and often have a purpose for CFOs and for founders, but it's just, I was going to say, I think good to be aware about what the true cost is, because what we often see is that people think that they're paying very, very low rates and therefore are not seeking new alternatives in terms of financing, even though they have become, let's call it, more borrower friendly and a more safe investment for a lender. But they think that they have very, very good terms, and therefore they're potentially not seeking other options.
I like that. Okay, so somewhere in the wording of the contract, there's a difference between the money you get and the total money you got to repay, right? That seems to be, whether it's discounted, called a fee, or added on, there's a difference between what you're getting in your bank today versus the total which you pay back. And there's a correlation or some relationship to the period, right? So if you're going to repay that loan in 6 months, that amount, that 10K that we spoke about, if it's repaid in 6 months, well, that's equivalent of not a 10% interest rate, it's a 20%. There's 2 6 months in a year. Or if it's over 3 months, you times it by 4, that kind of thinking, right? So I like most of these loans, you're right, are whatever that amount is, the 10K divided by 100 times by either 2 or 3 gives you a pretty good estimate of what your real APR is. And if you compare that to what you could go if you're going to go to business loan, and business loans, yeah, we'll talk in different countries. It's different, but yeah, you shouldn't be taking business loans for long-term growth of 20, 30%, right? Because then you're just giving all your profits to the financier. But I do like also that you're framing that there is a time and a place for these loans, because they are so easily accessible for short-term funding. But you've got to be able to then think about refinancing that if you're going to continue to grow at that rate. So I think there's a lot of wisdom in that.
And to add in that, you obviously have to think about what are the alternatives, right? And often the alternative for early stage e-commerce companies is to go and try to raise equity, and that will often be even more expensive than these loans, right? So in comparison to what's typically on the table, it can be an attractive offer. Now, what I will say then is, like, with equity, it has a positive impact on your cash flow, negative impact on your dilution. Here it's the opposite, or vice versa, right? So negative impact on your cash flow, positive impact on your dilution, or a neutral impact on your dilution. So that's important to be aware about, because yes, giving out loans to companies that are, let's call it, in the early days, you're sort of sub 5 million of revenue, you might not have audited statements, you might still be sort of burning a little bit of cash, or just sort of at break-even point. From a lender's point of view, when the upside is capped, they will see this as a risky investment, and betting on that you in the future will be able to, in the future will be able to turn to profit and pay back the loans. And generally, equity investors can be kind of more focused on the future, because they're looking at the upside, versus lenders tends to be more focused on the historicals and want to do their assessment based on what's happened and not on what's hopefully going to happen. So I just want to put it out there that it can be a good option when you compare it to what else is potentially available for you as an early stage company.
But we'll definitely cover a section in this discussion where we talk about different funding options, because I think that's important. The starting point, and I think and again, this is the majority, a whole bunch of guys are also going and raising seed equity way too early, right? And as you're saying, it's expensive. This first concept for us to understand, and I want to make sure that the listeners are very clear in us raising the big risk that we see in the majority of sellers. Let's call sub 10 million all the way down to $500,000 sellers, is that majority of you are getting into situations where you've got these revenue-based loans that are never ending. You can't get out of them. You're having to take another loan to pay for the next deposit or the next final payment. And the problem is you might not have understood the cost of capital. At some point, that is not the right solution for long-term growth. They have a place, but if you're going to choose to do revenue-based, understand the cost. And the cost isn't the $5,000 extra you're paying. You need to convert it to an APR or an annual percentage rate calculation. If you do that across all your different types of funding options, that's how we decide what we're doing. Revenue-based loans are very opaque and difficult to understand. Hopefully this conversation has helped with that quite a bit. Right. So Linus, we've discussed the risks of not understanding your revenue-based loans. I think what so many founders or e-commerce founders miss, that more traditional business owners are usually better at, is thinking about maximizing or optimizing your working capital as a starting point before you run off to, start getting your revenue-based loans or getting seed capital. This is something you raised kind of regularly with me. Can we talk a little bit about the wise thing for people to do here in optimizing working capital? How does that work?
Yeah. Now I think it's a really working capital is really important for all companies, especially for early stage e-commerce businesses or omnichannel companies. Often companies comes to us and say, hey, we want to take out some loans to support working capital. And what we would say is always, well, before you kind of take out debt, which will cost you money to fund the working capital, what have you actually done to try to optimize this? Have you spoken with your suppliers? Have you spoken with your logistics providers? What have you potentially tried to tweak to give yourself a more optimized working capital? I think that's what fundamentally always needs to happen before people start going out to sort of take loans to fund this. I appreciate if you're super early, you don't always have a huge amount of leverage on your suppliers and whatnot. But if you're a founder and you're a CFO, your main task is to be a negotiator and to build partnerships with, especially key guys like your suppliers. So that's what we always would recommend people doing before sort of start thinking about loans to find working capital. I'm sure you have a similar view as an accountant with tens and tens of years of experience.
Absolutely. I think it's also just worthwhile. Let's just define or explain what we're meaning by working capital. You and I are finance guys, so this language comes naturally to us. The majority of listeners here are going to be business owners, right? Probably with more marketing skills than you and I could ever hope for, but maybe not as strong finance in terms of the language of finance. So working capital, and Linus, you might have a different way of defining this. Working capital is not just your cash, but your cash, the amounts that are receivable. In the e-commerce world, that could be money sitting in your Amazon seller account. Also, if you've got wholesale suppliers, they owe you, they pay you in 60 days, right? Also in inventory, right? I include inventory that's on hand in working capital. And then we deduct from that all your short-term payables. some interesting discussions about whether credit cards are included or not. I include the credit card balances, right? Now, adding those up, adding that working capital balance up month on month is very important because you understand where you're at. And I think there's a lot of financing options inside of that working capital calculation. So I think, Linus, correct me if I'm verbalizing it differently, but can you pay, instead of your suppliers, where you pay them 50%, or some of your Chinese suppliers might be having a 50 or 80% upfront payment, right, when you started, but now you've been trading for 6 months. Maybe you're only putting a 20% deposit down. Maybe the other 70% or 80% you're only paying, a month after the goods are received. That opens up your financing compared to going to get the same working capital loan, right? That's revenue based that you would have repaid in that same period. You could also be carrying the right amount of inventory. If you overstocked, too much money sitting in inventory, therefore you got no cash. If you've got big business to business or wholesale customers who are paying you in 120 days, well, maybe you can give them a 5% discount if they pay you cash. That's still cheaper than the revenue-based loan, right? And the last one that I see is, especially for our US founders, I hate credit cards. But, man, some of those US credit cards, if you're getting started, it's so easy for you to get a 50 or 100 grand credit card where they often will give you no interest for 90 days, right? There's some crazy offers because the banks know you're going to expect you to keep that credit card balance going. They'll be expensive once you're out of that period, but maybe that's an option as well to get started. Why not think about those things before you run off and get a loan with a 20 or 30% APR? Am I verbalizing that relatively well, Linus?
Yeah, I think that's a really good summary. I think one trend we're seeing, which I think can be very, very effective when done right, is people selling on sort of pre-order terms to the customers, especially if it's sort of slightly larger items, right? Or I think when there was a little bit of a sort of shakeout in the e-commerce space, many players realized that they needed to make their revenue a bit more, let's call it, recurring, and were trying to sell on different kinds of subscription plans, etc., for your customers. And there you could have an amazing opportunity to also charge up front, offer your customer a discount if they'll, for example, go on a quarterly or a 6 months or a yearly or even multi-yearly subscription of your products, if your product is suitable for repeat purchases. Hopefully it is. So I would add in that as well. And then I think we often see many clients sitting with, to your point about inventory. Yes, it's obviously great to have, optimize your inventory. And often we see companies sitting with big piles of what I would call sort of dead or slow moving inventory in their warehouses, which is, just costing them a huge amount of working capital, and this inventory is never getting out. I'll just try to go and get it liquidated, or offer it to your customers, or use it in some sort of marketing campaign or whatever it might be, just not having sitting there. But I think you summarized it very well, Richard.
The inventory one actually, I think deserves a few more seconds. But you and I share a customer that we've worked with, where you've transitioned them through these different stages. And what they did well, for instance, was they've got a very high value brand. Like, everyone wants their product. So what they did is, when they were starting out, before they could get funding, there was a Shopify app that managed pre-orders, and they were managing pre-orders like 3 months out, right? So, but they were taking the payment on day one, and the order was only being shipped 2 or 3 months later. So if you've got a very high demand, very unique product, get the customers to fund it, right? I've also had customers who first launched their products on like Kickstarter, right? Which again, you can plug into your normal retail sales channel, but you're getting people to fund you up front with no cost of capital. So I like that. I didn't actually think to mention that. And then on the inventory side, I'm going to just talk to founders directly for a second here, in that as you're growing, you're usually paranoid and you think the worst crisis in the world is stocking out. most of the time that is probably the most expensive or damaging thing for your business, especially if you're like only on Amazon as a sales channel. But at some point, your demand or growth for your product will stabilize. And you got to read that well, because if you're stuck holding too much inventory, that's what we're talking about here. Now you've got huge working capital investments in inventory. You've got a big revenue-backed loan, which is stripping all your profits out. And now you're using revenue-backed loans to fund the same revenue cycle over and over again without the growth. And you're just giving all your profits away, right? So maximizing working capital as early as possible, maximizing working capital efficiency, and managing the cost thereof is important. Don't rush off to revenue-based loans until you've looked at working capital in a lot of detail. I think that's a really wise input, Linus.
Yeah, I mean, it's I agree, and I mean on what you, maybe this is something we will cover later, but what you mentioned there with regards that profit needs to be sort of the key metric. In most cases, I agree. What do I mean with most cases? I mean, most e-commerce businesses are typically, founder owned and run. Like you created this business to, hopefully create some success and wealth for yourself and not for others. I mean, if your company is growing, yes, that's obviously great. And if you think you can get it to a size where you can sell this company, that's obviously amazing, and you want to get to that sort of sellable size or whatever it might be. But the reality is that most companies today who get sold are trading on a EBITDA multiple, right? So you need to show, or even an EBIT multiple, or even like an inventory multiple, or whatever it might be. So profits is what people are looking at, and not what your revenue is. And if if you're creating a business where you kind of say that I want to have this and never sell it and just take out dividends, or maximize that or salaries, then why really grow and get into this sort of payday, what we talked about before with the release financing? Why get into this sort of payday loan, golden handcuff situation? Yes, you might be growing a bit more, but at the end of the day, there's not going to be more cash left in the business for you to take out. But you'll probably be sleeping a lot worse, thinking about whether you're going to be able to pay back these loans or not, right?
Exactly. I think that's the crux of what we're really getting down to today. Cool. Linus, we've covered the big. There's a whole bunch of risks here, right? But the big risk, we've covered the big risk that most of us see with sellers, being these revenue-based loans that are used for too long and too much of the debt funding. Huge amounts of profits being given away with excessive interest. We then spoken about the ideal starting place, which is maximize or optimize your working capital to get started. And then there's going to come a point where, there might be a revenue-based loan, but what are the different funding options? What are the approximate kind of cost ranges for those different funding options, as well as some risks and benefits? Because that's what you're doing, right? You're analyzing those different options. Do you want to just take us through the options as you see them?
Absolutely. So there's lots of different options available. Like if we talk about options now as actual loan or credit products, and not optimizing working capital, or not using your 401k, for example, there's lots of different options. I would typically categorize them in sort of two sections. Like we have short-term time financing products, and we have long-term type financing products. Like the short-term financing products tends to be cheaper because lenders are taking less risk. This is typically your your ABL facility or something like that, where you're using your stock or your debtors book, receivables, to finance working capital often. And then you have these longer term loans, cash flow loans, or EBITDA loans, for example, as I would call them, which are typically then used for let's call it long-term investments, either organic or inorganic, i.e., buy other companies or assets, for example. And I would say that these different products sort of become available to companies at different stages depending on their size and their profits and the size of the balance sheets. Typically, when I say size, first I mean revenue, but generally lenders look at either profits or the size of the balance sheet. So depending on what that is, these different products sort of become unlocked. In terms of the typical sort of cost and structure, I mean, if we just talk through the most kind of obvious or common ones that we see e-commerce companies using, we've talked a lot about revenue-based financing, right? I think generally these products have payback periods between sort of 3 to 12 months. Now there are, longer structures available out there. We see revenue-based financing products going up to as long as like 5 years, and I think in such cases they can actually be really, really attractive and good financing options, especially if you compare them with an option to raising equity. Then it basically becomes like a true revenue share type agreement. In terms of cost of capital, they would be typically between sort of 20 to 30% interest rate, effectively. What to look out for with these ones? Yeah, I would say make sure that you understand how they impact your cash flow, and that you understand what the true cost of capital is, and that you know how you potentially could get yourself out of the payday loan sort of golden handcuffs, if so to say. Moving on, let's talk about asset-backed financing, or often called ABL, asset-backed lending. This is typically something that is used by e-commerce companies when their balance sheets become a little bit bigger, and hopefully it's the asset side of the balance sheet that is growing predominantly, meaning that they have more inventory or more receivables that they can leverage and offer as security to a lender. And because they're offering some sort of security that can be liquidized in an unfortunate sort of situation, whether something unpleasant would happen with the company, the lender can offer you a much, much lower cost of capital. Like very often interest rates here would be somewhere between sort of 6-7% all in, that's including the base, up to sort of 20% interest rates. Now, in terms of use of proceeds, these products are typically sort of 2, 3, 4, 5 years, often with an interest-only structure, meaning that you're not amortizing on this loan, so they act sort of as a bullet, and often they're renewed once they come to the end of the term. Many e-commerce businesses use this for funding working capital, but I think they can also be used for longer growth term plans, or even buying competitors or assets or whatever it might be. In terms of what to look out for, I mean, because they have a lower cost of capital, or there's a lower return threshold from the lender side, they're also demanding a bit more from you as a borrower, right? So they will put in different types of covenants to make sure that your business is in a healthy state, and you need to monitor these covenants quite closely. Often you need to have some sort of minimum net working capital position or tangible net worth position, i.e. how much equity you have in the business if we take out the intangible types of assets that you have on your balance sheet. So they will make sure that if we're using assets here for a base of lending, we want to make sure that there's assets left in the business, and also that you can cover your interest rate and debt service expenses on some sort of multiple. So you need to make sure that you can meet covenants, that you have sufficient amount of borrowing base, i.e. you're not taking out money and then your borrowing base, i.e. your inventory or your debtor book, dramatically decreases, which then will make the lender tell you, hey, you've borrowed, X amount of capital, but you only have Y amount of assets available. You need to kind of fill this gap and pay us back quickly. So that's what I would say you need to look out for there. But I would say any company who has, sort of $2 million or dollars, pounds, or euros, worth of inventory and receivables can get an asset-backed facility and get a really, really cost-effective financing product for different kinds of use cases.
Okay, so we it's almost like there's a different stages to the business, right? So you're starting out, you haven't got a business, you're probably putting your personal money in, maybe using a personal credit card. It's all linked to you, right? The banks, everyone's getting something, right? The business gets trading. You've got to now jump up your inventory. It's a bit more than cash and you've got on hand. It's a bit more than you've got available on your credit card. Credit cards, you use the 30 or 60 days and you repay it, right? Then you use a revenue-backed kind of loan to help with that first 1 or 2 or 3 inventory purchases, right? And you're paying very high effective interest rates, right? You've then got a bit of a record now. You're sitting with $1 million, $2 million, $3 million worth of inventory on your balance sheet. It's now time to go and match the correct type of debt with the correct type of assets. So you're looking at your asset-backed loan then, which in essence has 2 benefits. You have a longer repayment period and a lower cost of capital. So your monthly cash flows are so much more favorable, i.e. you can actually trade, make profits, store some profits, and repay the loan without running out of working capital. In a perfect world, though, we spoke about even before the revenue-backed loans, or even before you increase those revenue-backed loans, we're trying to optimize working capital. Be smart, because you don't want to be sharing. Every time you're taking out loans, you're giving away a piece of your profits, right? So Linus, we've spoken about all the debt options. One of my, let's call it a bit of a pet hate, and this is a Richard thing. This is not a truth thing. But on all the groups I'm on, also I've come across a lot of entrepreneurs I work with. They're in early days, not even doing $100,000 a month. They spend more of their time raising seed funding or equity funding than getting on with doing the business and learning how to sell more. How do you see debt funding versus equity funding, especially in early stages, in terms of cost of capital and appropriateness of fit?
I mean, I think it's a very important topic. I mean, most often you need some sort of capital to start a business, right? Like you need to build a website, you need to buy some products or to develop the products, or to build some distribution, and that costs a bit of money. Like if you don't have the money yourself, then you're gonna have to find it from somewhere else, and that often means then raising equity, because raising debt it's not an option when you don't have any revenue, profits, or assets, right? Or even if it's just very little. So then, your only option sort of becomes raising equity. Raising equity is very, very expensive, and I think most people should try to avoid it to the extent they can. Again, unless you're sort of Kim Kardashian, or you're a founder with a couple of successful exits, or stories under your belt, then raising equity would be very, very cumbersome, time consuming, and expensive at the end of the day, especially if your company will be successful at the end. I mean, giving away 10, 20, 30, 40, 50% in the early days, which we unfortunately often see companies doing, rather than just having a bit more, let's call it, gravitas or a longer term view on their business, and just trying to build it up a bit more organically, rather than trying to sort of put it on steroids from day one. It would be very, very expensive, and I think many founders will later down the line, when they're sitting there with a successful business, sort of kick themselves and say, hey, why did I not just take bit slower and not give away this share in my business, because that 10, 20, 30 or 40% could be, I was going to say, worth millions and millions and millions of dollars. And then if we're talking about cost of capital, then your cost of capital is way, way higher than any revenue-based financing loan or such that exists in this world. So I think that's my view on why you and I share that equity is very expensive. Again, it's not, you can't say that it's the same for everyone, but for the majority of people, it's a very, very costly way of funding the business.
And I think this is more of a US thing than the rest of the world, because you've got things like Seed Invest, you've got these online platforms where you can kind of crowdfund, and also everyone has got some family members who are willing to put money in. But when you're talking about equity being expensive, to give that, I've seen funders who took 100 grand when they started, and now they're doing 30 million in sales and making 8, 9, 10 million in profits. Well, if they gave away 30% of the business for 100,000 4 years ago, what was the cost of that 100,000? Well, if it's 10 million that they're making in profits, they're giving away 3 million now, right? In that profit. And that's just heartbreaking, right? Yeah. So when they're starting out, they're not 100 grand you can take out of your mortgage, or 100 grand you can borrow from your 401k. So I always ask the question when someone's about they're running off to take equity and they don't want to put their own money in or borrow against themselves. Well, why would someone else give you that money, right? If you aren't willing to borrow it against your mortgage or take it out of your savings. So I almost take it as a bit of a red flag. But I think understanding how expensive that could be, someone who really is going to make a success of their business, that 3 million a year out of the 10 million profits, makes no sense to borrow 100 grand today for 30% equity. I do like what you're saying, though, is like, for instance, if you were going to partner with a Kim Kardashian, or we keep using Kim Kardashian for some reason, but like someone who brings a lot of value, that's different, right? So someone who maybe has a warehouse, right? Or someone who has huge website building skills, and they're willing to put a bit of time and money in. That's a different story, right? If someone's willing to add value, then they contribute more than the original cost of capital. I think that's a fair statement.
Absolutely. I mean, the right equity investor can, propel and accelerate the business, not only, with the money, but they can add, true expertise, within the sector or the category that you're operating. They open doors, right? They add credibility. Maybe it's actually something that helps you to, negotiate better supplier terms with, for example, by saying, actually, we have certain types of equity investors that are very, committed to what we're going to do, and we're going to grow and make this a very, very big thing. So maybe that's something that you can use as leverage in your discussions with suppliers, for example, or generally attracting talent is something that equity investors also can help with, both directly and indirectly, right, in terms of showing the credibility and maybe selling your future employees the kind of the journey that you're hopefully on in a slightly easier way, with some third party sort of validation that someone else who's credible that also believes in what you're doing. So sure, there's a cost of capital to the equity that you're giving up, and often it's expensive, but it can obviously be incredibly beneficial, and really be a game changer for you in the early days, if you get the right guys on who's willing to actually help and not just give you money.
Yeah, I think that's incredibly important, right? So my pet hate, I think, is maybe a bit of wisdom for everyone, is spend less time running around trying to get seed capital, grow the business thinking how to use your own capital. And there is a world where you are extremely successful, where you live the rest of your life regretting giving away 30-40% for that 50 grand startup money. Think about that very carefully, and with what your plans are for the future and your hopes are for the future. Asking yourself what's the wise thing to do, not just today, but also the wise thing to do given your future hopes and dreams for the business. Cool.
Absolutely.
Right.
I would rather, I was going to say, think about, using equity as an instrument to incentivize your employees, or using equity to find some great advisors and give them some sweat equity, people who can help you to open doors, give you advice, maybe even open the doors to the right debt funding partners later down the line when appropriate.
Agreed, because everything for your debt funding partners is their risk reward, right? So there's always this, we've got asset-backed loans, you've got equity, but there's also people who are willing to fund you money in debt forms where you sign over personal surety against other assets, right? And so there's this relationship of risk for the lender versus return. The more risky the loan is, the more expensive it'll be. So, of course, someone who's just backing against revenue of your startup Shopify store, they're going to charge you a lot in interest. You're high risk. But if you go all the way to the other extreme, for in the US, someone's giving you an SBA loan or a business loan where they ask for surety over your house or your personal assets, chances are that's going to have a lower cost of capital for them, right? So understanding and weighing up those calculations is really important. And again, at some stage, when you get to, let's call a balance sheet of anywhere from 2 million, 5 million, getting an expert in to help you analyze that will more than pay for itself. And I think I'm just, again, Linus, so glad to have you on here, right? Because I've seen you do this for a few firms that we work with where you've halved their cost of capital and extended their payment terms from 6-month loans to 2 or 3 year loans. So I think we've done well in covering the different types of loans, but the principle of cost of capital, understanding what that is, and timing of repayments, ultimately, you need to understand those to calculate the impact on who's getting what part of the profits. And if you don't do that, you run the risk of growing your top line and your revenue, but you might not be keeping as much of the profits and not getting any of the cash that you think you deserve. And that is just heartbreaking, and it's something we see so regularly with so many sellers. Linus, we've covered such a valuable topic today. I really appreciate your time. Viewers are going to get a bit confused with some of the finance terms, right? Mm-hmm. So first of all, I think, what makes for the right timing for someone to come and work with you at Tech Credit Partners, and how do they actually get hold of you and sign up to work with you? I know you've got a bit of a kind of a waiting list or backlog at times. How's that defined, and then how's it best for them to get hold of you?
Look, we're super passionate about helping people find the right financing products for their situation and for the goals that they want to achieve. So we're happy to speak with any company, really, whether we can work with them directly now or sometime later in the future. What we're passionate about is making sure that people find the right finance options for themselves. So I encourage everyone who's thinking about these things to reach out, and we'd be more than happy to have a conversation with them. Now, in terms of sort of when we typically structure, engagements and advise clients in a more sort of formal way, is when they're looking to raise somewhere between sort of 5 to 50 million of debt capital. That typically means that you have assets on the balance sheet equivalent to that amount, or maybe a little bit below sort of 5 million, but you see that it can sort of grow to 5 million in a relatively short amount of time, or that you have EBITDA of 2, 3, 4 million. That's when I would say that it's a good time to have a conversation. With that said, I mean, there are also loan products for, let's call it, really, really fast growing companies that don't necessarily have a big balance sheet or are yet super profitable with multiple millions of EBITDA. And that would, for example, be for, venture-backed brands of different forms. And they can often access something which is called venture debt financing. We didn't really cover this in the conversation, but it exists there for the venture-backed companies, and it's typically a hybrid instrument or funding form, which is a combination of some debt and some equity. So if you're growing really, really fast, you maybe have revenues more than sort of 10 million. And when I say really, really fast, you're growing like 50% year over year at least, and you have equity backing from institutional reputable players, then you can also reach out and have a conversation with us when you're sort of getting to 10 million, I would say. And in terms of how to get in touch with us, you can go to our website. We have a Calendly link there embedded on the website, so you can just book a call with me and my team, and we'd be happy to speak with anyone there.
Brilliant. We'll put that link in the YouTube description. So just to sum up, the smaller founder, self-funded, maybe starting to use credit cards, will move into a world where they're using revenue-backed loans at some stage. Let's call that up to 1 million, 2 million in sales. There might be then a period between that where they just keep biting the bullet on revenue-backed loans, trying to hang on to profits and pay those things back. They might do some personal kind of business loans with their banker. An SBA loan is still probably available to them if they're in the US. And then at some stage, they want to separate their personal risk from the business risk. They need a proper balance sheet with assets to work with someone like yourself to get the ultimate loan, which is going to give them the lowest cost of capital, the least personal risk, and the best repayment terms. And ultimately, that's driving more profits to themselves and maximizing the value of their business. And I think that's a really good indicator of when you're sitting at 5 million in assets on your balance sheet, you want to get a hold of Linus and his team. We'll put a link to Linus's Calendly link in the description below. Linus, thanks so much for the time and the insights. And I'm hoping that we start working people into a space where they actually get to keep profits for themselves and get out of this revenue-based debt trap that they never escape from. It's heartbreaking to see. Thanks for your time. And we look forward to the next podcast, and we'll share details with Linus in the link below. Please feel free to reach out. He's a great guy, likes to share the knowledge. Thanks, everyone. Thanks again, Linus.